Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Good morning and welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us again. So let's check what happened on Friday. Global stocks fell as US trade policy weighed on investor sentiment. This came ahead of President Trump over the weekend promising to impose a 30% tariff on the European Union and Mexico from the beginning of next month. So Wall Street ended lower on Friday after President Trump intensified that tariff offensive, particularly against Canada and Brazil. And for the week, the S&P dipped 0.3%, the Dow lost about 1%, and the Nasdaq entered flat. This week, investors turned their attention to second quarter reporting season in the States and the impact of tariffs. Among the big names reporting results, JP Morgan, Netflix, and Johnson & Johnson. On Friday, shares of Nvidia rose to another record high, while elsewhere among the Mag 7, Meta shares closed lower on reports that the company is unlikely to offer more changes to its pay or consent model, increasing the risk of fresh EU antitrust charges. Drone makers AeroVironment and Kratos Defense surged after the US Defense Secretary ordered more drone production and deployment. Kraft Heinz lifted on reports that the company is preparing to break itself up as the packaged food maker grapples with persistent weakness in demand for its brands. And Levi Strauss shares jumping higher after the apparel seller raised its annual revenue and profit forecast and beat quarterly estimates. Well, President Donald Trump has said he will impose 30% tariff on imports from Mexico and the European Union from August 1st after failing to reach a comprehensive trade deal with two of its biggest trading partners. The president has demanded that Europe drop its own tariffs, saying the European Union will allow complete open market access to the United States with no tariff being charged to us in an attempt to reduce the large trade deficit. Well, the European Union is resisting retaliation at this point, saying it would continue to press for a negotiated settlement. Meanwhile, Mexico's proposed tariff level is lower than Canada's 35%, but President Trump said he wants both countries to do more to stop the flow of fentanyl across its borders. Well, the US two-year Treasury yield rose on Friday to 3.89%, the 10-year at 4.43%, and the US dollar rose against most major currencies, including the yen and euro. As those trade tensions were rekindled, the Aussie dollar trading at 65.8 US cents. And Bitcoin hitting another record high over the weekend, above 119,000 US dollars. Oil prices jumped more than 2% on Friday as the International Energy Agency said the market was tighter than it appears, while traders also considered those US tariffs and possible further sanctions on Russia. Brent crude at $70 a barrel, copper rising marginally, iron ore up around 0.5% to $99 a tonne, having surged around 4% last week. And gold was up more than 1% as investors sought the safe haven asset in response to the tariff threat. Spot gold at $3,355 an ounce. So let's get across those market moves. What is influencing investors at the moment? Isaac Paul joining us from Ashkelon Capital. Isaac, happy Monday to you. Welcome back. Good to see you. So, of course, we've had much further development on the trade front in regards to what President Trump had to announce over the weekend with, we first had Canada, Brazil, now the EU and Mexico. Substantial tariff threat, you would say, because they've got 2 weeks to work that out. Yet markets have been complacent about this, haven't they?
There really have been. I think there's a level of complacency and maybe just exhaustion around the tariff policies that are being threatened, rolled out, rolled back, promised on a certain day, pushed back to August. It's very difficult for markets to take all of this in and put some level of probability or attach some level of probability to these being implemented. And I think in the near term, that's going to leave markets just sort of trying to look through the bluster, maybe ignoring it and allowing valuations to stretch higher. But there is a real risk that the tariffs are implemented much higher than we've seen already, and that's going to be a risk to the economy.
How real is that risk, do you think? Because given what we've seen in the past, of course, there's a perception that President Trump merely uses this as a threat. That brings into play that taco trade that he always chickens out. You think perhaps some of these could stick?
I think that some will stick. There's going to be a level of tariffs that is much higher than we had at the start of the year. It's not going to be the 30% plus that's being threatened here, but there is a risk that a higher level is implemented. And of course, this is not just on the US. Other countries may decide to push back a little harder on that belief that President Trump will roll back or chicken out. And that leaves a risk of some retaliation or a ratcheting higher in tariffs from both sides, which would be very disastrous. And that's being heavily discounted by markets. But it is a risk. And of course, when two countries choose to play high-stake games like this in the tariff and trade policy sphere, there's a risk that it is implemented and growth is hit quite hard.
Now, of course, we've yet to really see the impact of these tariffs on US consumer prices. We are going to get a read this week. What's the expectation there? Of course, it's one of the issues that the Fed is trying to grapple with at the moment.
They are, and it's a very difficult problem because we haven't seen a real impact from tariffs yet, and that's partly because there was a lot of front loading of imports from the US ahead of the tariffs. But we've now had a month or a couple of months of implementation on tariffs at a higher level, and so the consensus is for core CPI to push higher year over year and move close to 3%, which is well above the target for the Fed. And that's going to be a challenge for them because we have growth slowing. It's clearly slowing. It's probably going to slow further with the uncertainty around tariffs and the actual implementation. And if inflation doesn't play ball and keeps rising higher, it's going to be very difficult for the Fed to cut in the near term.
Comes at an interesting point too, Isaac, of course, as we head into earnings season. What do you think we're likely to hear, particularly in terms of guidance?
It's I think we're going to hear more uncertainty. It's going to be a term that's going to be thrown around a lot. There'll be some discussion about tariffs, but the position we're in right now is a world where expectations have been ratcheted so low. The bar for beating earnings growth expectations is very low. So it may look like good outcomes, but I expect earnings growth will be slowing from where it was in Q1, which was fairly solid, low double-digit growth, and the guidance I think will be towards slowing earnings growth. So overall, while we might get a lot of beats this quarter, I think it's not going to be an extremely positive guidance or earnings season.
Overall, how are you seeing the US market at the moment, just in terms of its valuation, given we are at or near those record highs?
It's overvalued, I think, or at least very stretched, and that means, or it doesn't mean that we need to see a material drawdown. It just means we need to prepare for returns that could be much lower than what we've seen over the last 3 years, and markets and investors have got used to double-digit US equity market returns over the last 5 years. If we see something that looks a bit more like historical averages, 7.5%, 8% or so, that could feel quite bad. But actually, that'll be a pretty good outcome, I think, if we can get through the next 12 months with sort of high single-digit returns. Given all this risk we have around tariffs, that will probably be a very good outcome for investors.
So, Isaac, where are you seeing better value at the moment?
We still think US government bonds and Australian government bonds offer pretty good returns, especially with yields backing up towards that 4.5% level at the longer end, you're going to get some downside protection if we do see tariffs implemented or growth slow. You could also move into high quality investment grade corporate credit as well and pick up a decent yield there with some resilience if growth slows. So we do have a preference for high quality fixed income over equities at the moment.
Now, also this week, Isaac, we get a data dump from China, including growth. What are the expectations?
Well, what we've seen is some stabilization in China's economic growth, and it looks quite likely, at least, that the reports that come out will be close to their 5% growth target. And that's been helped along by retail sales, which is recovering, and domestic demand, which seems to be recovering, and just picking up the slack from trade, which is going to suffer a little bit amongst these trade policies. So overall, China last year looked like it was going to really struggle to grow at 5%, but early signs this year suggest that the monetary policy and fiscal policy that's been implemented will help growth get back towards that 5% level. And
of course, there is still so much detail to come in terms of hammering out some sort of trade deal between the US and China.
There is. I mean, yes, there's been a framework agreed, but there's not a lot of detail there. And of course, China's spent the last 6 or so years preparing for this and making sure that they can continue to trade with the rest of the world and the US via the rest of the world. That's not something that President Trump welcomes. And so there will be further negotiations. There will be further discussions. There is risk that the negotiations break down and we see tariff levels like we saw in April and May. So there's still quite a lot of risk around this. But for now, I think China's just stabilizing and doing okay.
And just before you go, do you have a view on Europe at the moment? Obviously, given 30% threat there of tariffs, they've got 2 weeks to work that out. Sounding as though from the European side that they're confident they're going to get some sort of deal.
Yeah, it does sound like there'll be a deal, and there's a lot of willingness from European leaders and countries to make sure that a deal is implemented, or a framework at least, and negotiations continue around specific sectors. But overall, Europe's growth has been okay, and their fiscal support and fiscal policies and fiscal growth will help their growth in the long run. But I do think that over the course of this year, in the nearer term, we're likely to see growth slow and disappoint expectations that have been built in. And that leaves just a little bit of risk for equity markets that are pricing in a real re-acceleration in growth.
Isaac, great to get across what you're seeing globally. Thanks for joining us from Ashkelon Capital.
Thanks, Andrew.
Let's return home. We are expecting a lower open to get the week going. SPI futures off by around 13 points. Stay with us. Nadine is going to bring you the open in just a minute or two.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.